community, good morning. Welcome to another morning live. Happy Thursday to you. We're going to make a lot of progress today. We're going to talk about a lot of crazy stuff. Obviously, you guys know that I think the house market is an absolute dumpster fire right now. But before I really dig into this episode, let me talk to you guys just about a couple updates, and this will be fast. So tomorrow's live and probably on Friday's live, if I do it, it's going to be a little bit early because I have a field trip tomorrow and I love hanging out with my children. Thank you guys for letting me do that. And then also I am preparing to travel. So hopefully by, maybe sometime in November, I'm going to start traveling around the country again. I don't know if I already told you that, but I'll be bringing you to like Utah, New Mexico, maybe Oklahoma, maybe Illinois, but maybe even New York. But I'm traveling and I'm super excited. So sit tight for that. And also, you guys, as far as my hair, Ray, I appreciate you asking. He says, what's the deal with my hair in the picture? Ray, that's just what happens sometimes, man. I'm in my 40s. Well, I'll be 40 this year. And brother, I'm just not perfect, man. I'm just a normal guy. Remember, you guys, I became a YouTuber on accident. You guys get the bad and the good days. So that's how the video works. So I'm sorry when I'm on my bad days, but really appreciate you guys. We're going to start by talking, and really starting with, why the market will crash. I constantly hear people asking, why do you think the market's going to crash? Is it just your feelings? Why would it crash? So that's where we're going to start today. And a huge reason that is the consumer. I think the consumer is really is the category that is going to lead to continue price crashes. And I don't think that consumers can afford prices. Even if prices stay sideways, I still don't think consumers can afford it. So we'll start there. I have some really, really good stuff to go over with you guys today. I'll do my first timestamp right now. And we're going to start our market update with a Redfin article about Austin. Now, this came out this morning. And really what I wanted to point out is how the landscape in real estate is changing. It is a little bit slower than we'd like, but nevertheless, we need to understand that certain things are lagging. And I appreciate that comment, Lisa, about my gray hair. I'm getting older, guys. I mean, it is what it is. But here's the thing I wanted to point out. Remember, Austin was a pandemic hotspot. They basically blew up in equity. Okay, the prices of houses in Austin blew up. A big reason that was migration. Now, here's the thing. Now that many of these metro areas are no longer affordable, these places are starting to lose migration. And understand that some of these places, Austin being one of them, one of the things that was propping up the home prices was the migration. So now that they're losing that, that's one of the reasons why Austin is leading price decline in the nation. So I thought it was interesting. Here's the chart right here. I mean, you can really see the run up starting in, what was this about this? So right here's 2018. So Austin, Texas, huge, massive run up in migration. Obviously that just messed things up for a lot of people, especially if you were a local or native to Austin. It's a little bit heartbreaking, right? Because you see these out of towners with all of this money come in and make the house market even worse. But look at this, guys. They're now losing people. So there's now a net outflow. And again, this is the first time that's ever happened. That's really, really astonishing. So there's a lot of stuff going on in Austin. I suspect some of the same things will happen in places like Phoenix, places like Las Vegas, Salt Lake City, Utah, and things of that nature. Now, let me show you guys a report from the Federal Reserve of New York about consumers. And I'm going to be making a video a little bit later today about the updated foreclosure information. And I'll include more detail about the consumer. But what I wanted to point out is the defaults. So a lot of the things we should be paying attention to is, what I'm paying attention to anyways, when it pertains to consumers, is the delinquency and default rate. When people stop paying their bills, that's when everything goes boom and bust, right? So here's the trajectory of credit cards, auto loans, and mortgages. And let's compare where we're at for the defaults right now compared to great financial crisis, okay? Starting with credit cards in blue, all right? So credit cards in blue. First of all, the trajectory. Look at the trajectory of the defaults. And you guys, I'm sorry, delinquencies. These are 90 days. These aren't 30 days. These are 90-day delinquencies. So it's like almost, past the line of no return for a lot of people, right? Once you go down that road, it's really, really hard to come back, out of the financial challenge without any damage done to your life. So look at the credit cards, guys. So this is the highest level of delinquency with credit cards since the great financial crisis, since about, would you say, 2007? So we have this, you guys hearing me on this? So we have the same amount of credit card delinquency since 2007. That's really quite astonishing. Now, also, look at the car loans, guys. The car loan delinquencies is the highest it's same since about 2007. So we have credit card delinquency, people not paying their bills, about the highest level since 2007, or at 2007 levels, not the highest level since. Highest level since Great Financial Crisis, which was 2008, 2010. But right before that, guys, again, we have higher credit card delinquencies right now. Auto loan delinquencies are as high. The difference is this, the gold line. The gold line is the mortgages. You can see it tick up. You see that tick up right there. But the thing that I wanted to point out is the mortgages will, I mean, that's going to increase the delinquencies and mortgages. And I know that's not a good thing, but that will increase. Obviously, there's many Americans right now that purchased before 2022 and then refinanced, that are sitting with a lot of equity and payments that they can afford. But the people that are purchasing after 2022, obviously, that's just a whole nother box of people that are in danger of foreclosure. I estimate that number to be roughly 15 million American households. I think 15 million American households right now are upside down on their home. So let's look at some of the stuff I'm about to show you. This is insane. All right. So I'm going to make my way through this very quickly. I wanted to show you how bad the spending has really been. If we look at the federal debt to GDP, okay, if we're just looking at the federal debt to GDP, we have the highest ratio since World War II. So we're spending at the same level, okay, and getting in debt at the same level as if we were fighting the World War II. Are you kidding me right now? Is that not shocking to you guys? I mean, look at the trajectory here, guys. This isn't a war we're fighting. We had lockdowns. It was COVID. This is insane. But anyways, federal debt to GDP, highest level since World War II. And it's been that way for a while, you guys. Really crazy. Now, obviously, that tick up right there was the money printing. You see that huge spike up right there. So very interesting. One more time, let's look at M2, because this is also a very crazy thing to witness. This has not happened more than likely in any of our lives. Because the last time, if we look at the M2 money supply growth, the last time we had negative year-over-year M2, decline was back in 1930s. Back in the Great Depression. We haven't had this happen in about 100 years, a little less than 100 years. You can see that right here. This is the 110-year chart. So I had to go back 110 years. You can see that M2 right here. So it went under the zero line. So the zero line is right here. You guys can see this is the zero. Okay, right here. It went under that. So we were losing money. See that? Same thing's happening right now. It's worth paying attention to these matrices, especially, if people when their heads are in the sand, they're risk on, overly optimistic. These are really important details. Wouldn't you guys agree? Let's move on to home price median compared to the household income. So basically, this is your PE ratio. So this is another huge reason why I'm saying that consumers cannot afford these prices. The PE ratio is unprecedented. Right now, it's about 7.4. That means it takes 7.4 years of your salary to pay off a home. In the 70s and 80s, it was in the 3 and 4%. So look at this. See? 3 in the 70s, going back to 1973, 3.62. Never even hit 4 till about, late 70s. It wasn't even in 4 till the late 70s. So the consumer's nowhere near the same. We have nowhere near the ability to sustain these prices like they did in the 70s and 80s, because in the 70s and 80s, prices were sustained. But again, look at the PE ratio. We're at 7.4. That's insane. The housing bubble got to 6.79. It didn't even hit 7 during the Great Financial Crisis. Really astonishing stuff here. Also, guys, here is the chart. If you guys want to access this, show it to your friends. That really, I like this chart because it shows us the bubble. To me, this is a very clear indication of the asset bubble when it pertains to the actual prices of homes. I'm not talking about transactions. You can see the run-up right here. This is the Great Financial Crisis run-up. And really what we're paying attention to is the divergence between the black line and the red line. So again, big run-up here. We crashed back down, started going up, and then it just really got out of control. Still really out of control. But that's a good way if you guys want to follow the actual bubble. What does the bubble look like? I think that's a really good way to do that. Now, another reason is this right here, okay? This is the payment to income ratio. And what I pulled up here is basically the cheapest and most expensive places to live. And I want you guys to put this in perspective. Remember, they're coming up with these ratios based on gross income, based on income before, again, before taxes and medical, 401k, all of that stuff's taken out. So reality is we use our net income to live our life. It's the net income, not the gross, it's net. Either way, they're using gross income and not taxes and not insurance, not property tax, not insurance. So these numbers are all way worse. But look at the cheapest place to live right now is Cleveland, Ohio, at 29.9% of your income going to paying your mortgage. That's decent. That's really literally the only metro area on this list that's 25% or under. But again, remember you guys, it's way higher than that because they're not using net income, property taxes, or property insurance. But look at some of the overpriced cities. This is crazy, and House Hacker feels this. I know you feel this, House Hacker. Look at San Diego. San Diego's number 2. House Hacker lives in the San Diego area. San Diego's number 2 at 60.4% of your income. That's not sustainable, and that's probably why, and correct me if I'm wrong here, House Hacker, do you see a lot, because I moved out of California about 12 years ago, but House Hacker, tell me if you see a lot of homes and residences with multi-generational residents. Are you saying, in other words, like 2-3 families per house? I remember when I was in Orange County, California, I would see many houses that had 3-4 families. And I'm not talking big houses. I'm talking small houses, like maybe 1,800 square feet. How are you going to fit 3 families in there? That's absolutely bonkers, you guys. So anyways, another reason, payment to income ratio, I think that's ground for concerns, as far as lack of sustainability. Now, look at the 10-year. Okay, this sucker has been going up. You never know what's going to happen when the market opens. Never know what's going to happen when the market opens with this 10-year. I mean, it's all over the place, but it is up to 4.88. Obviously, we hit 5% pre-market this week. Now, here's why that 10-year dropped. Apparently, I can't remember the investor name. It's not Michael. Is it Michael Berry? I don't know. But someone was shorting treasuries that got out of that position, and basically the 10-year went down as a result of that. But now, once again, it's going up. So to me, this is signs of, many different areas of pressure, with the rate going up with the 10-year, which basically means people are selling the 10-year and don't want any part of that 10-year. Okay, because it's not the long end. The 30 years is the long end, but it's the longer end when we compare at least to the 10-year. But this is the economy killer right here. So this is killing the economy. As long as we remain elevated, I think we're going to be okay. Remember how desperate I know I was at the beginning of this year? Aloha. Nice to see you, brother. I love you, man. I'm sorry I don't talk to you more. I really appreciate all your support, man. I see you out there, brother. I appreciate you, man. Anyway, so we're at Bill Ackman. That's right, Bill Ackman. Thank you. Bill Ackman. So anyways, guys, this is the economy killer right here. Let's look at the 1 month. This is kind of the zapper of liquidity, I like to say anyways. This is the 1 month. This is what I have a lot of my money saved in. So the money that I've saved to invest in real estate, I'm not in the stock market anymore, although maybe I should have bought VIX, whatever. So I'm just risk off. And I'm enjoying my life. I'm increasing my purchasing power. And this is where my money's at. But again, remember, you guys, when this goes up, when the 10-year goes up, as far as the rate, it's likely that will go down, because more than likely people are leaving here, the 10-year, and they're going here, right? And another thing is remember the reverse repo market. So the reverse repo market is like the liquidity gauge. It kind of gives us an idea of how much excess money is in the system, is in the market. Okay, so that's what this looks like right here. So this is the reverse repo market. It's kind of been sideways this whole week. Okay, starting about so there's Monday right here. So we're down a little bit, but it's not a huge difference. They're not yielding a lot because, again, they're yielding, let's see here, 5.3, and the 1 month is paying out 5.4. So they get about 10 basis points more. But this is, guys, this is where the banks and depository institutions store their money, for lack of a better word. So they're storing their money here. This is like the one-day treasury. So they can put their money here and they can get it out tomorrow. So put it tonight, get it out tomorrow, and they yield 5.3% annualized. Pretty cool. Now take a look at the inversion. We are so close right now. I'm putting the 5-year. So I'm showing you guys the 5-year because, again, I want you guys to understand that black line that you're seeing right there is very important. So the black line is very important. Because when the blue line goes under the black line, that's what everyone's talking about as far as yield curve inversion. That's the economic warning sign, like, hey, there is pain on the way. There is recession on the way. risk off, or at least be very cautious, be very, very careful. So we only have 19 basis points to go. So typically when this uninverts, usually 6 months, usually there's no scientific math, but if we average it, about 6 months before the pain really hits us. And you guys, we're very, very close, 19 basis points away. So as long as, again, this 10-year goes up today, you guys can see this 10-year still going up. And I don't know, I don't have the 2-year up, but as long as this continues to go up, more than likely this is going to continue the road to an inversion. It's not uninverted yet, it's just headed that way. And also what I want to point out is what you guys are seeing here is what's known as a bear steepening. Okay, steepening means it's on its way up, uninverting. And bear, because it's the longer end of the yield, the 10-year, not the 2-year, that's uninverting. And generally, what a lot of people are saying is that means that the recession and the pain is going to be even worse. It's going to be even worse than if it was the 2-year or the bull steepening, if you will. So again, more grounds for being cautious. But the problem is, guys, is the market doesn't believe the Fed. Here's See Me Fed Watch. Okay, the market's like, nah, we don't believe you, Fed. You do what we say. So the Fed is just like, yeah, we'll see about that. Here's this is the November probability or market's anticipation of a rate hike. Okay, they have written off 100%, written off a November rate hike, and they are now barely. It's only a little bit, but they're pricing in a rate cut. They're pricing in a rate cut. Look at this. It's very, very low. It's only 2.8%. But what the heck? So they're not even pricing in the probability of that second rate hike. However, in December, you can see that it is still elevated at 29%. I like to go all the way to July because I want higher for longer. And if we go all the way to July, okay, this improved. If we go all the way to July, we have about about 28% likelihood that we're elevated. Okay, so that we stay elevated. Now, June, I like what the market's saying for June. June's sitting way higher. So June's at 47-ish, about 47%. That's really, really good because we want to maintain this tightening, the restriction. We want to maintain it because we know it's needed. Obviously, now we're going to listen to our first video. This is a great video. This is going to cover a lot of stuff. Basically, it's going to go into the fact that they believe it's a Fox video. I fast forward through there's 3 minutes of all this political nonsense, and I just wanted to spare everyone that because I don't want us fighting. I don't want our community fighting. There's another time for that. But they're going to go into that. We need 1 million active units. So, a million more active units. I like this video. This is a really good video. If you guys don't mind, please let me know that the audio is okay, and I hope you enjoy.
A lot of economic data coming out next week. We'll have fresh numbers on CPI. Markets will be watching that, thinking, what's the Fed going to do? But we're also watching the housing market very closely. And the Wall Street Journal with a piece today talking about the fall in home prices, that we blinked and it might have happened. It may already be over. I've been watching prices really closely. I didn't really see the kind of drop that I was expecting.
Yeah.
Inventories are obviously very tight, holding things up. So is that where we stand? Is it over?
It's a unique market because a large portion of the population have mortgages under 3%. A lot have them under 4%. You don't exchange a 3.5% mortgage for a 7.5%, 8% mortgage. You just don't do it. You see the kind of house you could buy now. Let's say you had $2,000 a month to make your payments and 20% down. You could 3 years ago you could have bought a $500,000, $600,000 house. Now you might get a $250,000, $350,000 house. So sellers are reluctant, and buyers can't find anything to buy. So it's a hell of a 1-2 punch.
But at some point, that's going to break. Sellers are going to have to sell at one point. If they want to move up, they're going to get.
But you don't sell. I mean, if you sell, let's say I'm sitting on a house and I bought it 10 years ago. Do I sell, make a big profit, and give it all back and higher mortgage payments over the next 30 years?
Not unless you're making more money or something. You had a life change.
It's a huge thing to give up. I mean, listen, if you could buy a house for cash, fine. But if you have to take out a mortgage, it is a difficult decision. This is why we have almost a record low number of people moving for jobs.
Yeah,
people are reluctant.
Do you think this market lasts for a while? You think we're going to have tight supply?
I think interest rates have to come down.
Yeah,
I think when interest rates come down, I think the housing market will reignite, so to speak. But right now it's a sideways market, and Although there's a ton of homes being built now,
Yeah.
there's a ton of homes in the pipeline right now. That could break it too, maybe over the course of about 52 weeks.
And we know interest rates, I mean, that's anybody's guess, but mortgage rates are not expected to come down for quite some time. It's going
Yeah.
to take some time for that to catch up, right?
Yeah. Although I got to tell you something, I think the Fed is going to find itself in a real serious pickle, particularly if they hike anymore. I hope they don't hike anymore. We heard from Susan Collins yesterday, Lori today from the Dallas Fed president. They sound reluctant to go right away, but they also want to kind of quote unquote keep the door open. A huge mistake. Again, looking at where things are going, this so-called lag effect, it's right behind us. It's right in our rearview mirror, and it's bearing down on us like a tidal wave.
So I think to your point that you started with about the credit card debt and what we're seeing with the consumer, I think it's taken longer, but people have slowly started to run out of money. They've also started to run out of credit cards to put things on, and that impact is probably going to hit late in the fourth quarter or early next year.
Right.
And then all of a sudden you see the Fed tightening. Wow, here we are. That
so-called excess savings of $2.1 trillion down to $100 billion. Credit card interest rates on credit cards, 22% an all-time high. Some of these store cards, Macy's came out last week with the earnings. I had no idea. Their card is 34% interest.
Jeez.
And now we're starting to see the bankruptcies start to pile up here as well. So
they reported a lot of people defaulted. I'm sorry, but they reported that. I didn't know they had a 34% interest.
Yeah,
rate.
the store cards are but the average store card is like 29%. So
this is the economy that Joe Biden wants to run on. Bidenomics, here it is.
He's trying, but it's one you could tell people it's great, but the numbers we're talking about, people live them. They build them every single day. And by the way, folks are smart. You know how they always say you go to these small islands and these tropical islands, how whenever a big tropical storm hits or something, they look around and the animals had already left. They have an instinct. Households in America have instincts that they know things long before Wall Street economists know, long before the White House knows. We know what's going on, my man. So you can keep telling us it's great out there. In the meantime, we're heading for the hills.
That's right.
Oh my gosh. Charles Payne, thank you so much for stopping by. Wish we could keep chatting, but
I like it. I like the video. I don't agree with what he's saying. I mean, how could price drops be over when we're not even in the recession? Okay. Some things are in recession. Like I'm in real estate. I feel the recession right now. Like I see it clear as day. But how could things be over when we haven't even got to the pain per se? I mean, it's painful right now. Don't get me wrong. But like the breaking, how could they say that? I did like that they pointed out, obviously, that bankruptcy rates are absolutely exploding, consumer bankruptcies and business bankruptcies. And then also, guys, 34% on credit cards. Credit card debt is the worst debt. And then the 30-year mortgage is the second worst debt, in my opinion. Let's look at mortgage rates right now. So we're going to go into our mortgage update. Right now, I'm going to be fast for you guys. So let's get started. So right now, you guys, we're sitting at 7.9%. We're still elevated. I don't even care if they do another rate hike, to be honest with you. As long as we stay this high on interest rates, I think we're going to be okay. Now, I'm pretty sure that most of us will welcome higher interest rates because we want lower prices. But let's see how expensive a 7.9% really is by looking at it's not here. No. It's not here. Okay, so I must have it. Oh, here it is. I don't know why it's way over here. Okay, it's right here. That's weird. Okay, so let's just see how expensive things really are. So if you guys get the average price loan at $328,000, your real interest rate is 150% because the total amount of interest you're paying is $530,000. If you want to pay your amortization schedule down, remember how I said how horrible mortgage debt is? If you want to pay 5 years off, that would take only $16,560, and you would save the first 5 years, or whatever year you pay in and how much you pay down. You would save the first 5 years in interest, which would be $126,000, which what? Is that 1/3 of the loan? You save 1/3 of the loan in interest by paying $16,000. Y'all get it, right? Is that crazy? That's crazy. It's crazy to me. It's crazy to me. All right, so let me show you now because it's got a little bit unorganized. Oh, and I'm going to show you MLS. Okay, here we go. So let's look at the unaffordability. I did the video yesterday. Here's the $157,000. All right, so it takes $150,000. I want to show you guys what it takes to buy the average or median priced house. Median priced house about $412. Okay, look up here. So here it is. So to get here, $411. Okay, but just a normal house, just the average house, nothing magnificent. The normal house? What? You need to make, look at guys, $157,000 to afford it. $157,000 and $94,000. Oh my God. And it's 50% more expensive to own versus rent right now on average. No, thank you. No, thank you. 94,000. I'm not going to do it. I'm not going to do that. I'm not going to do that. That's crazy, you guys. But anyways, thought you find that interesting. Let me show you this. Okay. I'm going to show you guys my MLS because we haven't done this in a while. I'm going to show you Kingwood, and I'm basically going to, I'm really glad that we've been watching Kingwood this whole time because basically I believe we have more inventory right now than we have the entire year in Kingwood. I'll show you that. Oh my gosh, another one just came up. Okay, yeah, this is a record. Okay, so things are changing. Thank God, man. Oh, thank God. All right, take a look, guys. We have now 90, and I know it's small, but that's okay. We've been monitoring this little tiny housing market. We got 93. That's, if I'm not mistaken, that's the highest amount of inventory we've had all year. Is it time to celebrate? No, it's not time to celebrate yet because we need the prices to go down. But y'all, that is a beautiful thing. Now, obviously, I like to categorize this by price per square foot so I can see what is really a good deal right now. And you guys can see the price cuts. Everything with the red arrow is a price cut. So price cut, price cut. I mean, they're dropping. People can't afford these houses. People in here, look at guys, the first house, 418,000. You got to make 157,000. You know, I don't know per se. Every situation is different. Property taxes are more in Texas, but you got to make around $150,000 to afford that first house. And that is the most reasonably priced house at $107 a square foot. So the best priced house, $107 a square foot, you got to make 150,000. Is that not bonkers? That's not. I mean, come on, guys. 3 years ago, it was about 80,000. Just 3 years ago, about 80,000. That's really surprising. But that's my active MLS. That is, you know, I love using my MLS. One of the biggest advantages of using multiple listing service is accessing comparable data. Your comps really kind of show the value of your house. So we're going to go into our next video that's going to be talking a lot about consumer delinquencies. Consumer delinquencies are a really, really big deal. And I'll argue that's really what happened during the great financial crisis. People weren't able to pay their bills, which led to delinquencies. Why weren't they able to pay their bills? Was it because of the adjustable rate mortgages? Nah, maybe a little bit, but it's because they lost their job. Unemployment was what, close to 10%? I couldn't even get a job. I was in real estate, so I was the first to lose my job. But it's important. So this is a really good video on delinquencies. Let me put my timestamp on there. And I really, really hope you guys enjoy.
Is going to have maybe the most outsized impact on where stocks go because of what we're just witnessing today. Yields are up, stocks down, yields come off, stocks go up. Is it that simple?
Well, I don't think it's simple at all. I think we're going through this whipsaw environment where people are trying to decide whether we're okay with the 10-year going down or we're okay with the 10-year going up. Is it sending a bullish signal or a bearish signal? And I think one of the biggest things, I know I've been talking about this ad nauseum, but is the yield curve inversion and the fact that it got down to the narrowest level since a very long time. We got down to 12 basis points today. We're back to 22 basis points inverted now. But that's a really small level. And thinking about the idea that it's not the yield curve that causes a recession, right? The yield curve doesn't actually do anything. It's more the signal of what capital looks like in the economy right now and what people's expectations are for the economy. Mm-hmm. And at some point, I do think the 2-year will start to come down, which will then send a more decidedly negative signal for what might be to come.
The real question, Joe, is whether, you know, look, we've had this big move in rates and whether yields are topping out. Now, I don't know how closely you watched every tick by tick of the market until showtime today, but it appears to us that, and others, by the way, who I've spoken to, that Bill Ackman moved the market today. So we worked up this chart, which shows you the time that he tweeted that he covered his long bond short, which he's had on for a long period of time. So we're showing you that now over on that other side of your screen, right? So, you know, Dow's down by more than 200 points. Ackman tweets that, and it basically the same exact time, you had yields start to come down, and then stocks do the exact opposite, which went up. Now, the Dow right now is up 24 or so points. It appears that's what happened. He says, quote, "There's too much risk in the world to remain short bonds at current long-term rates." The implication being all that risk means people are going to end up buying treasuries, and that's going to force rates lower. What do you think?
I think it's a great trade by Bill. I think it's an excellent trade.
Time to cover, you mean?
I think
that short?
No, I think the fact that Bill consistently throughout the third quarter was messaging to markets that he was short treasuries. He sat with you at delivering alpha and basically doubled down on that position, reiterating his short position. And like any good trader, Bill has the ability to observe the environment and then change his mind accordingly based on what he sees. And I applaud him for that. I think it's a great trade. I agree with his assessment of where the economy is. I think the economy is, without question, decelerating.
He says it's weaker, than people think,
Absolutely.
and that the data would otherwise show. We could show you. I mean, there's the intraday. Guys, throw that back up, please. That was the intraday of the 10-year. I mean, we could show you just an intraday of the S&P. As well. You'll get the same idea if you overlaid those, by the way. I mean, you'd see from the moment that tweet came out with his trade that he covered the long bond short, the market just flipped.
It did. And today is the type of day where there's no real earnings, there's no real economic news. So to have that type of news where someone who has been speaking so much about the Treasury market and his position in the Treasury market, now he covers it accordingly, you're going to get not only a technical lift in the market, but you're also going to get that lift based on perception overall. I don't think it washes away a lot of the challenges that we have as it relates to earnings. And we'll talk a little bit about that as the show moves on. But certainly you're not getting rewarded for good earnings and you're getting punished for really bad earnings.
So, Anastasia, I mean, we can move away from Ackman, the person for a moment and just talk about the idea.
Sure.
That, have rates topped out? Or are they in the process of topping out? Because essentially that's what matters more than anything else.
Right. I think near term, the rates may have topped out. And the reason I say that, we're coming out of an incredibly strong Q3, and at least we're going to get the exact number later this week. But that's not likely to be repeated in the fourth quarter. I think economy is going to be a lot slower. So the growth factor that's propped up the 10-year Treasury, I think we can see some of that go back. We also have the core PCE inflation that comes out this Friday. We're looking for a year-over-year print of 3.7%. 3.7% on core, that's actually a really great number that's showing the inflation is decelerating. And then, we got the central bank policy. I think we kind of get it now. I think the markets get it, that it is high for longer. And so I think we've priced in the appropriate amount of that. So for those reasons, I think the 10-year can pause. I think there's another deeper story here, and that is the delinquencies are rising, charge-offs are starting to rise, corporate bankruptcy filings are starting to rise. So there is definitely some weakness that's emerging under the surface. So that's why I think Blackman was saying that there's definitely risks that are impossible to ignore.
Yeah, I would say that there are risks impossible
We challenged ourselves to
for
create the world's most
people
emotional.
to ignore. But, there's consumer defaults. That's a fact. And it is skyrocketing. The mortgages are still low for many reasons, loan modification, the type of loans. But the biggest reason is there's no unemployment. There's not a lot of unemployment. And there's still the people that purchased prior to 2022, there's still equity in their house. So they could just sell. Why would you foreclose your house if you could sell and make $50,000 to $60,000? It doesn't make sense. So that's what we're saying there. Let me show you guys the market's expectation of inflation. This is something that the Fed watches a lot. And here it is. This is the 5-year break-even inflation rate. This sucker really skyrocketed up. That was really, really, really astonishing. They got a series of data that came out. And basically, this is the market kind of starting to wake up and starting to understand that the lag effects of the tightening are right at the door. They're starting to knock on the door. Things are starting to crumble. Things are starting to break apart. We know that. We know that. There's no question that the restrictions finally starting to work, right? We don't want any more bailout. We don't want any more money printing. If that happens, I don't know what's going to happen. If they continue to bail us out every year, they're pumping money into the hands of the elites. Who knows what's going to happen? Because that's exactly what they did this year. And we had to start over again almost. It's really, really frustrating. But this needs to go down to 2. Okay, it's at under 2. This is at 2.38 right now. So the Fed's watching this. Expectations are really, really important. So again, this is a little bit unhinged. Now it's shooting downwards. This is the direction that Fed wants to see. But again, that shot up. So the market understands, in my opinion, the pain is here. The pain is literally just knocking on the door. It's, a lot of people thought it was going to come sooner, including me, but that changed again. And I remember my soul changing, the bank bailout. All right, guys, we're going to listen to the next video on the rental market. They're going to go into the rental market inventory. Hopefully by the time this video is done playing, we'll have our updated new home construction data. So that's out. That should be out right now. We should see some updated values of new homes and how much supply, and we'll also see the revisions. Hopefully that's out. You guys enjoy. Video number 3 on the rental market, please.
The jump to buying a home instead of renting, maybe think again. A new report from the Wall Street Journal finds there's never been a worse time to buy instead of rent. If you look at the data, it's now 52% more expensive to buy a new home. And as interest rates keep going up, it may stay like this for a while. So what can prospective home buyers do? Joining me now, Redfin chief economist Daryl Fairweather. It's great to see you, Daryl. All right, so we're seeing this mismatch. I understand the last time that there was this big gap was right before the 2008 financial crisis. What gives?
Well, this is not the 2008 financial crisis. One big difference is that homeowners are sitting on record low mortgage rates, so they have really no reason to sell. And the only way that prices can come down is if homeowners start to sell and that supply increases. For the time being, although it is incredibly unaffordable to buy a home, there's still a lack of homes for sale, which means that prices are stable. They're actually up 2% from last year.
Okay, and I'm looking at 4 metropolitan areas where this is not the case. I just want to go through those. We have Detroit, Philadelphia, Cleveland, and Houston. In those places, it is still it's less expensive to buy than to rent, and it looks like Detroit is the place to do that. But I would imagine that this is fueling, if you have to sell or if you want to buy, it might be fueling a migration pattern among what areas are getting new entrants.
Well, the people who are making out well in this market are those who are selling in high-priced areas like coastal California and moving to more affordable places. Because say you're selling an $800,000 home, you paid off half the mortgage, you can then take that $400,000 and buy a home all cash in a more affordable place like Houston or Dallas or Arizona, Las Vegas. So those people can avoid this high mortgage rate problem altogether. And there's what's keeping the market afloat right now.
Daryl, what happens, and we've spent a lot of attention here on CNBC to commercial development, multifamily properties, that if you're going to go rent in one of these places, they are also facing skyrocketing costs. They have to go in and refinance. If they have a floating mortgage, they might have to refinance at higher rates. Insurance prices are skyrocketing, and saying that for a lot of them, cash flow is driving up. Is there a tipping point where you think it goes back, we lose multifamily houses and things like that, and then renting looks like the better, or buying looks like the better deal than renting?
Well, for the time being, there are a lot of multifamily properties coming online, which makes it look like rents are going to be at least not accelerating next year. They might even fall in some areas. That doesn't necessarily mean that there's going to be a whole lot of homeowners who decide to sell and go rent instead. The kinds of properties that are coming online tend to be one-bedroom homes that might not work for families. But it is a good thing that all of these new multifamily properties are coming online because it provides a more affordable option to people who have been priced out completely of buying a home.
Okay, so let me know what y'all thought of that little piece. I mean, I like the interviewer, but the speaker kind of just felt like she's all over the place. I mean, no reason to sell. Like, I hate, they don't have reason to sell. The thing is, when people buy their primary residence, and almost everyone looks at it as their forever house. Like, I've already bought 4 forever houses in my lifetime. So no reason to sell. I mean, I think that narrative is foolish. I understand that there's a lack of affordability because of interest rates. So where would you move to if you sold your house? But people are going to move for many different reasons that are even out of their control. Divorce, death, medical, big one, job relocation. In fact, right now, if we really look at it, active listings, not counting new construction, existing homes, I'm going to say 30% of the active listings for existing homes right now are distress sales. It's normal. So all of the narrative, oh, why would they sell? I mean, come on, man. I mean, aren't they supposed to be the professionals? Why are they asking questions that they already know the answer to, right? They're saying things they already know the answer to. Divorce, reload. I mean, come on with these people. I'm so sick of it, you guys. I'm so sorry. I'm frustrated. Now, let me show you guys how many units there are being built right now for units in buildings with 5 units or more. So basically right now we got 1 million homes coming to the market. Okay, 1 million rental units. All right, so we got 1 million rental units probably coming to the market within the next, say, year and a half. Well, I'm going to tell you guys exactly what's going to happen. Prices of rent is going to go down. Okay. But now the question is how long will it go down before it starts going up? Right? Because again, honestly, more than likely, when we have this credit event, we go into recession, construction is probably going to die. And if it dies, then obviously there's not going to be a lot of building. So something that we'll eventually want to come back to and keep our eyes on is obviously them not making. But right now, you guys, they're constructing a whole bunch. I mean, look at this. Historically, I don't think that they've ever made this many rental units ever. So lots coming to the market. Let me just take you guys to the next thing here. Now I wanted to show you this. This is new privately owned housing units completed. These are SFRs. So again, according to this data that I do not believe, and I have the evening video I'm going to show you tonight, but million units. So there's going to be completed million units this year. So 1 million units more for new homes. I thought that was pretty cool. Obviously, we would like a little bit more, but I thought that was cool. So we're going to go into our next video, you guys, which is going to be that we basically want that 5% mortgage rates are going to be the new normal. And honestly, do y'all remember me saying like, hey, after we go through the recession, after all of that, I think we'll be okay. After all of that, a proper reset, rates need to be 5%. They don't need to go under 5%. We're in this problem because of the low rates, not the high rates. The high rates are to correct the low rates. Do you see? We wouldn't need high rates if it wasn't for the low rates. Y'all see the problem with the low rates? We need higher rates. It's a fact. Everyone should see this right now. So I like this video. You guys, hope you enjoy. And if you can, let me know the audio is okay.
As rising rates are impacting the capital markets, we want to bring in Beth Hammock. She is co-head of the global financing group at Goldman Sachs. She's former global treasurer of the firm as well. And Beth, let's talk through what this all means. Before we even get into the rates, let's talk about what we think is coming, because you had Bill Gross saying that he thinks we're headed for a big downturn in the economy. You had Bill Ackman saying the same thing. You look at a lot of different measurements. We were talking about the, subprime auto borrows 60 days plus past due. These are some concerning things that are starting to line up. How does that play out in what you're seeing in the markets?
Sure. When we step back and think about where the interest rate markets are, you have to look at all the Fed speak we had last week, where the Fed is telling you that they've done most of what they want to do for the year. They've taken rates up pretty significantly. We're in a restrictive territory. And the Fed speak you've gotten is basically saying they're around where they need to be. Maybe there's one more hike. Maybe we're done, somewhere in around there. But the back end of rates, which has really been the mover over the past couple of months, has really put pressure. And part of what you heard in that Fed speak is that this higher interest rates in the back end is going to substitute potentially for more of those hikes that they need to do in the front end of the marketplace.
But higher for longer, do we believe that? If things roll over and they keep rates high, what does that mean?
Well, that's the fundamental question, is the economy going to keep holding up? So right now, what we've seen is that inflation has actually stayed reasonably elevated, coming down off of its peaks, but still reasonably elevated. The unemployment rate still below 4%. That's a full employment type picture that you're looking at. And broadly, the consumer looks pretty healthy. You're definitely seeing some weakness at the very bottom end, as even Coca-Cola talked about at that bottom decile. You're seeing a little bit of that weakness. But overall, the consumer picture looks pretty good. So our economist, Jan Hatzius, has had a great call that we weren't going to be entering a recession. And our view is that that's going to be the case, that we're going to stay in a pretty healthy market through most of 24. And the Fed won't need to cut rates until at the earliest, the end of 2024, and only very slightly. So if you step back and think about rates in a broader historical context, this period where money was free from 2008 to 2022, these zero rates, a lot of people grew up with that and they think that's the norm. I grew up in the 90s, so I think that a 3 to 6% yield curve, that to me feels like normal. And so this new 5% regime that we're living in, I think that could be sustained, and I think this could be the new normal on the forward.
It's the new normal, and it feels normal to a lot of us. But if you have built a business model, or if you're a consumer and you've built your life around this idea of lower interest rates, that's going to be a pretty rude awakening. And I guess the question is, how big of a shock?
Yeah, well, that's a transition we've been going through in the past couple of years, right? We've gone from this period of free money to adapting to rates being at 5%. And so if you look at the various markets where it's starting to have an impact, like the leveraged finance market, for example, that's a place where you're feeling in loans the effect of those interest rates moving up, because it's largely a floating rate market. And so if you look at the types of transactions that could have been done in 20 or 21, things that would have had 6, 7, 8 times leverage, Now what the market is focusing on is interest coverage. And to make sure you have that 1 3/4 to 2 times interest coverage, you're looking at leverage below 5 times in terms of the change. And so it's shifting how corporate America needs to think about the deals they're doing, but those deals are still available. If you go back to 2006 or the 90s, you still had a very healthy M&A calendar, just in a different frame.
What kind of chilling impact does that have, though? You can still get the deal done, but it's not going to be the same structure. It may not be as profitable for a lot of people involved or as lucrative.
Well, I don't think that it's necessarily less profitable. I think it just changes the types of targets you're looking at from an M&A perspective. You need to have more strategic value, and so you're seeing a lot more strategic M&A rather than sponsor-backed M&A, because you need to have some of those overall benefits of the combinations where it really makes more sense rather than just the free money adding to earnings over time.
What about the high yield debt market? How's that faring right now?
It's faring pretty well. I mean, obviously it's been a bit choppier, and you're seeing focus on the underlying companies. You're seeing focus on the underlying credit health of individual companies, and a lot more dispersion and selection between the different groups that are coming. But it's been robust. There's been issuance coming to market. There's a lot of demand in the market. There's a lot of cash that still wants to get put to work.
A lot of cash still wants to get put to work. That was a little bit surprising to me when we saw that bank bailout and the rebound this year, was how much liquidity is still out there. Now, do you guys listen to what some of these people are saying? I work really hard. I have at least 3 jobs. I have no consumer debt. I don't consider myself a strong consumer. And I have great credit. I have these really great things going for me. But does the consumer picture really look that good? Does it really look that good? I don't think it looks good. For me, it doesn't look good. We can't save our money. The prices of like the main necessities of our life, rent. And where does the American dream start? Home ownership? It's dead. It's dead. If it doesn't change and we don't go into a reset, we got bigger problems, you guys. We got massive. Is it even America even? I won't say that, but I'm frustrated. I'm frustrated because no one, you guys, is being humble about this. Almost no one is being, cautious. Let me show you guys. Let's see if we got an update. All right. I really hope this update. I love when this updates. Okay, so we started at 430. Okay, so we're looking at median sales price for new homes. This should be updated when I hit refresh. Okay, so we're starting at 430, 300. Let's see what it goes to. Oh my God. It went down, you guys. Of course. Of course it went down. Oh my God. Okay, so it went down significantly. Is it the lowest? Nah. Dude, look at this guy. The new homes the new homes, listen to me. And I like Top Villain through the come out. He's like, the market can sustain 8. I don't think that I wish, man, if the market can sustain 8, then we have a healthy market. We have the healthy consumer, right? That would be actually a good thing if they could sustain 8, but we can't. The PE ratio, the payment to income ratio, we can't sustain. If you don't believe me, look at the 70s and 80s. But look at this, guys. Even with the buying incentives, even with new home builders rewinding the space-time continuum back to 2021, they still can't maintain prices. What are we going to see when the existing home market has inventory? We're going to see the same thing. So with again, Lennar's offering 4.5, 4.25. They can't sustain. They're cutting prices 15, 20. They can't sustain. We see it. Look it. That's crazy. So the peak was October 2022 at $496,800, which means, let me do the math in my head. 80. Okay. Which means they've lost about $78,000 in value. Okay. And I know we're just looking at median sales price. People are like, oh, median sales price needs to come up with value. Well, if we look at the comps, median sales price has to do with comps. Comps come up with value, appraisal, 3 comps, subdivision. Come on, I get it. I get what they're saying. Nevertheless, $78,000. Boom. I was worried that was going to go up a little bit because these numbers are crazy. All right. Let's now look at this. Don't you guys see why I love this information? All right. So now we're looking at the monthly supply of new. You guys are going to love my evening video. Do not miss my evening video. Do not miss it. You better not miss that video. You guys are going to have your minds blown with how many houses are really out there. I'm talking 3 times more houses than what's listed on MLS. 2 of the 4 subdivisions. All right, let's refresh this. We're sitting at 7.8. We need 6 months of supply for it to be a buyer's market. So if new construction is doing so well, then why do we have so much inventory? Anyone? Anyone? No one? Right? Why do we have so much inventory? If it's just flying out the door, it's flying out. They're doing so well. Warren Buffett. Well, actually, if they're doing so well, then they wouldn't have 7.8 months. Let's refresh. First of all, comment below. All right. Oh, what's up, Luke? This is my boy. All right, you guys, if you want to know what's going on in Canada, okay, this is the boy. This is my boy right here. Luke, I want you on the channel. Luke, he won't. And I need to interview you, Luke, on Canada. If you guys want me to interview Luke, just type Luke. I'm serious, guys. Type Luke if you want me to interview him. I love this man. This guy's very smart, very humble, really good guy. But type in Luke. Okay, good. We got one Luke. Sorry, Luke. There's only a couple. Oh my God, you only got one like, Luke. I love you, dude. Keep doing you. I love that guy. Okay, we got another Luke. We got some Lukes. Okay, guys, you ready to refresh? First of all, comment below. Comment below and tell me, though, do you think this is going to go up or down? Okay, so are we going to have more supply or less supply when I hit refresh? I'm going to guess and put how many months. I'm going to say 8.2. Okay, I want 8.2. I don't know if we're going to hit it. Okay, you got some, look at Luke. You got some love in there, Luke. I love you guys. Thank you so much for sticking with me on my good days and my bad days. I really appreciate you guys so much. Okay, comment below. Oh, man. Hey, I got you. Man, sorry I haven't responded to you. I did get the chart. I thought it was cool, man. I know we're both super busy. I'll give you full credit for all your effort, man. This guy that I put up on the screen, this is a good guy. This is a good man. Megan, you didn't have to do that. I appreciate you, girl. Join the Discord. It's in yesterday's description of live. I'll throw it in the description of this live if you want to go to Discord. It's just a way for us to talk outside of YouTube. That's it. And Megan, you're wild, girl. I didn't know how wild Megan was until Discord. But anyways, I'm going to hit refresh. So we got, I think, 8.2. Okay. Anyone else guess? 7 months. Okay. Cameron thinks it's going to go down. So Cameron thinks it's going to go down. Tom thinks it's going to go up. I think it's going to go up. I know I'm really dragging this out, right? Am I really dragging this out? All right, I'm going to hit refresh. All right, let's see what it goes. Oh my gosh, it went down. No, it went down. You were right, Cameron. Cameron was right. Oh my, did you look first, Cameron? Did you look? Holy smokes. Okay, so it went down to 6.9. You see that? So it's 6.9. Darn it. I was hoping it would be higher for obvious reasons. Let me zoom in on that a little bit. Yeah, I mean, and they did a revision here. Let's see if they did any other revisions. So we were sitting at almost 10 months at the end of last year. Look at it go down. Still eights, some revisions done. But I mean, we're sitting at a lot of inventory. Still a buyer's market. Went down slightly to 6.9. Anyways, so sorry for all that buildup. I see you, Luke. Darn it, I wish that was up. All right, let me do some Q&As right now. All right, let's go 52-minute mark here. We got some stuff. Let me start on the bottom. Actually, let me start with Eric. So when will rates drop? Hopefully not for a long time. But, if we were to look at the dot plot with the Fed saying and then match that with CME, I mean, next year, the end of next year, maybe they start the end of next year, but the question is, how much will they drop? It's likely that unless something really, so the thing is like rates aren't really going to drop, like noticeably drop. A quarter basis point drop is not a huge effect. It's going to noticeably drop when something really, really bad happens. Now, we don't know exactly what is going to break, but when something breaks, they're going to cut rates. If nothing breaks, then they're going to keep us higher for longer, for as long as possible. So for the people that don't think the housing market is going to crash, the interest rates will be this high forever, so to speak. But again, they're probably going to start it next year. It'll probably be small increments. I very highly doubt that interest rates will drop significantly as far as mortgage rates in a month. I don't think that that's possible, but time will tell. Good question. Thank you for asking it. All right. Okay, so here's a question from Mary. Thank you for asking this question. Her question is can she pay principal annually? This is pertaining to an amortization schedule, and you can absolutely pay your principal annually, and she's talking about her mortgage. And basically, if you've heard of what biweekly is, biweekly, which can save you 5 years as well, by the way. So if you guys do biweekly, all biweekly is paying one extra mortgage payment a year. Can you believe? And you stay 5 years, 4 to 5 years. Isn't that crazy? So, Mary, you can absolutely do that. And I would encourage it. In fact, if you just make, again, one extra mortgage payment per year, you save a half a decade. Think about it. Think about doing it. I think it's a good idea. I think paying that sucker down is good. Okay, so here's a comment by House Hacker. He's in San Diego. Definitely appreciate you, House Hacker. Thank you for being a part of our community. When market crashes, so that's the point. That's the point that I'm trying to make. It's like they're not going to lower rates unless they have to, right? And if they have to, it's because something really, really bad has happened. Now, remember, something really, really bad happened this year, but they didn't cut rates. Remember that. Instead of cutting rates, they bailed out the banks. So we got a few things that we're looking at. Some real estate questions here that I thought were pretty good. Should I renew my real estate license? I've been absent since 2010. It just depends on what you're going to do with your real estate license. Right now is a really bad time in real estate. You ask any agent that. It's dead right now in the market. Literally, it's absolutely dead. The market's dead. There's no one doing nothing, for the sake of argument. So I would lean to yes, you should if you're going to buy a house, because there's some benefits of being your own realtor when you're buying a house. None more than the typical 3%. Usually you get about 3%. And you can actually use your realtor commission for the down payment of your house. So if you go buy the house, you can actually, through the transaction, use that commission as your down payment. So you can literally move into a house for, if it's a 3% commission, and so you get a Home Possible loan or Home Ready loan for free. No money out of pocket as long as the seller pays closing costs, because the 3% down payment is Home Possible and Home Ready. So I like people empowering themselves. I think we should all get our license, to be honest, but understand that there's a cost associated with it, and there's a lot of subscriptions. Again, Megan, I appreciate you, girl. Thank you. I didn't mean to throw you under the bus. I think you're amazing, and I really appreciate all your effort. Okay, you can't time the market. It's time in the market. Honestly, man, I mean, if you listen to what this guy just commented right here, I agree. I so agree with this guy. So think about what this guy, and this is why consumers do so poorly. This is why first-time home buyers get wrecked. You literally go and look at articles on the internet. Everyone knows consumers that are buying houses, and I hate to say it, but people look at us as chumps. They look at us as suckers, like emotional chumps that don't understand home buying. So experience is what helps you become great. You need experience. So I definitely agree with this man. But I will add that there are certain times that we want to hold, not necessarily time the market, but if we hold and review what's going on, I think that we can adjust our goals. Our goals shape our approach, right? So I wouldn't take this statement as fear of missing out. Don't just jump out, right? Don't just jump out and go buy a house. Have your goals in place, whether it's your payment, your affordability, your wedge, your cash flow, things like that. But I really like that he was pointing out how important the experience is. Here's a good one from BC. I type in the county I am in, and it has gone up 5% in 1 year. So I guess no crash here. So BC, this is what I wanted to tell you. Like, we got to be careful looking at year over year data. I'm not sure what it is from peak. Maybe it's up from peak. Maybe it is. Maybe it isn't. But here's the thing. I have defined a crash. Most people are not defining a crash. I have defined a price, not transaction, price crash as a minimum. And by the way, there's no definition. I've looked already. There's no, unless there's a new one, there's no definition of a house market crash. But I have to find a minimum crash as 15%. I think it's going to be worse, but I'm saying you got to start somewhere minimum. So if we look at that, BC, then technically none of the housing market has crashed yet, other than Austin and a few places in Northern California. So there is a but. So actually, some have actually crashed. But that doesn't mean that it has stopped. Okay, we're in a cycle. There's things changing. The government did bail out this year. There's still a lot of excess savings. So just because you can't see it in your market doesn't mean it's not coming. And we see that in the yield curve bear steepening. The bear steepening is suggesting to us that it is incoming, that bad things are incoming. So in other words, like what the other man said, we don't have to time the market. Just understand what a great deal is. That's why I do the market analysis. I want to purchase a house at 2019 levels. I want the seller to pay all my closing costs. So when I find that, I will purchase. So it's really important not to just stay on the sideline. You're on the sideline. It's really important to prepare and take the first hit, because if we get hit by this recession, I'm going to tell you guys, like, it's going to hit. It's going to hit some people we love. All right, here's another question. Appreciate you. Why does the media keep saying rates need to drop and say the chip prices? Because they don't. Because they're paid. So if they're on TV, TV works. And if you're on TV, you make money from the advertisers. Okay. If you don't have any advertisers, you're probably, and the same thing with YouTube. If we don't have any advertisers, we're not making any money. So ask yourself, who's paying for advertising? When you guys watch my videos, do you guys see real estate advertisements? Do you guys see real estate advertisements? I'm willing to guess that they're probably trying to make their livelihood, which is their sponsors, happy. I don't know. But a lot do say that. Again, and they don't even talk about, like, I never hear the bulls talk about PE. I never hear them talk about PE ratio. Other than Meet Kevin, and that's why I listen to Meet Kevin, even though I don't agree with a lot of what he's saying. Like, I respect that guy, because at least, even though I don't agree with him, he's coming up and he's telling us why he thinks what he's thinking. He's giving us data. A lot of people don't even do that on both sides of the coin. There's people saying just buy right now, and they're using data, and it's not even the right data. And then there's people saying that the house market is going to crash, and they're not even using the right data. And they're making me look bad. The other realtors are making the other people look bad. So at this point, I'm happy to listen to people as long as I know they're not trying to mess with my head. As long as I know that they truly believe what they're saying and they have a justifiable reason for saying what they are. I will listen to everyone. But it is just so depressing, the lack of caution. Okay, this is from Trey. Trey, appreciate you, dude. Always nice to see you in the mornings. Trey's like the first one here. He pumps me up. I'm almost tempted to get my real estate license just so I can get a house and never. And that's that. So Trey, say you buy a house for $400,000, 3%. If you get the full 3%, remember you got to give your broker a portion of your commission. But 400,000, 3% of that's $12K. So even if you just got your realtor license, to buy a property, I mean, it could still be beneficial, but also understand that you'll probably need help from your broker to help you navigate through a transaction if you've never done it before. And generally, a good broker will help their agents. Okay. Oh, this is a good question from Travis K. Okay. I remember this one. Should I sell my owner-occupied duplex and rent it out myself right away? Or I could sit on the equity. They bought it in 2019 and wait for current prices to fall before rebuying. So it's so hard for me to answer questions like this because everyone has a different situation, right? He's got his own preferences, his own goals. But I'll tell you, Travis, what I would do. Okay. First of all, I need to know, I don't know where you live. I don't know if it's California. I don't know how your property taxes are. I don't know how your landlord laws are. So there's a lot that I don't know. But my own philosophy is, and we see this with Wall Street, we see this with the REITs, we see this with institutional investors. I really don't think we should sell our real estate. Like if you're in dire straits and it just doesn't make sense, then yes, okay, fine. But overall, I don't think we should sell our real estate. I have my own house that I'm renting my house out. Now, I didn't buy that house to turn into a rental. I purchased the house as my forever house. Stuff happened, whatever. I was kind of forced to move. And my cash flow is amazing. So but the thing is, Travis, like, I mean, are you going to use the money for something? If you're not going to use the money for something right away, I just have such a hard time saying that you should sell your house if it's cash flowing good. If you don't need the money, if you already have money to invest, why would you? It just depends. It just depends. Because if you need the money and prices are going to go down and we know that the market is sideways and you need that money, it might be the best decision for you. But I don't know what you're going to do with the money. I don't know your cash flow. But my gut tells me if we can hold on to our real estate and turn it into an asset, then we should do that. I'm not saying take over the world. I'm just saying, maybe 2, 3, I don't know, a couple houses. All right, last question here. What is your advice for job relocation from California to the outside Dallas? What do you mean you must buy? Is someone forcing you to buy? I don't think you must buy because you're a non-disclosure state. Should my realtor share the comps? Help. So your realtor has access. Your realtor should help. If your realtor should be doing all of this for you, man. I don't care if they're in Dallas. Yes, they should be doing that for you. If you need help in Dallas, email me. I don't know if I can respond. You guys know I'm not representing anyone, but if you need help in Dallas, just type in Dallas in the subject line so I know it's you. But my advice, so it depends if you can get a great deal. If you could find a great deal at 8% interest rate with these overpriced houses, maybe you, and it's cheaper to own than rent. You have no consumer debt. You have an emergency funds, right? And you can comfortably afford the house, and maybe you should buy. But I don't think that's going to happen. I think overall, I think it's okay for us to rent for the meantime as we build ourselves up and watch the dust settle. You know, that's my opinion, but I know nothing about your situation, but that's what my gut is saying. My gut is saying you don't have to buy right now. That's what my gut is saying, but maybe you do. I know relocation is, is special as far as the employers. Okay. Scrog, it's nice to see you guys. Nice to see you guys. Trey, don't move, made it. Don't move, made it. Appreciate you. Vegas is here. Man, I love you guys. Cameron, really nice discussion today. House Hacker, everyone. Noel, I really appreciate you. Thank you for all your support. Okay, who would win the Todd would rock me. Have you seen that guy's arms? Todd is big. Jacob. Now I know I do some shark fishing and I get extreme, but dude, I will never let people see me coming. I will always say that I will lose because again, why would you lose the benefit of surprise? But he will rock me, man. Todd is a beast. Todd is a beast. Anyways, guys, I think that is going to do it. Make it a great day. Remember, if you're struggling right now with any type of depression, motivate yourself by your sacrifice to achieve. When I was going through my depression, when I lost everything, part of the way that I got my motivation back was by like me doing things that were hard. And really I did it through God. And I was praying. Honestly, I was praying. It was God. Okay. I was praying. I was reading the Bible and I was like, man, good job, Travis. Good job. And it helps, right? So I'm not trying to push my religion on you. I'm just saying that's what helped for me. So if you're struggling, be motivated by your accomplishments. Okay. And don't forget, guys, always, always, always remember to have goals. Your goals will shape your approach, and we definitely need that in this market. And I hope you guys have a great day. Do not forget, tomorrow is going to be an early morning live. I'm going to have to do a field. I'm not going to have to. I want to do a field trip with my daughter. So make it tomorrow morning early. And other than that, if you're out there investing in real estate, I wish you luck, and I hope you win.